Germany has slipped into repeated economic stagnation. France is barely growing. Italy is stuck below 2%. And Spain? Spain has recently been posting some of the fastest growth among the major Eurozone economies, clearly ahead of Germany, France, and Italy. Goldman Sachs didn't just notice this once the headlines turned positive. They highlighted Spain as a structural outperformer years before the data made it obvious. In this video, I'm going to show you three things: why Spain's growth is not just a tourism story, what has actually changed in its energy, labor, and talent model, and who this growth is and is not really working for. To understand Spain's current position, you have to start in its worst moment. In 2013, Spain's unemployment rate was close to 27%. Youth unemployment had pushed above 50%. Bond yields on 10-year debt briefly touched around 7% levels that raised real questions about long-term solvency. The IMF's 2012 report on Spain openly warned about downside risks to the country's ability to sustain its debt. For many policymakers in Brussels and Frankfurt, Spain looked like a permanently weak link. Too rigid, too indebted, too dependent on construction and beach tourism. A decade later, that picture has flipped. Spain is now one of the Eurozone's best-performing large economies, with growth around 3% in recent years, well above the euro area average. How do you move from near-our crisis to outperformance in just over 10 years? The first answer is the labor market and a political gamble. In 2012, Spain's government pushed through a highly controversial labor reform. It made hiring and firing more flexible, altered collective bargaining rules, and created new contract types. Unions saw it as an attack on workers' protections. The government paid a heavy political price at the next election. But over the following decade, unemployment fell from nearly 27% to roughly 10–11% by 2025. That entire shift cannot be credited to one law, but the reform clearly changed how companies hired and invested. At the same time, Spain secured one of the largest envelopes of EU recovery funds in Europe, around €150–160 billion, when you combine grants and potential loans. Here is the twist. By late 2025, European Commission data suggests only about a quarter to a third of that money had actually been deployed into real projects. In other words, the strong growth we're seeing so far is powered mostly by private sector momentum, with a giant public investment booster still warming up on the runway. Second driver, energy. In 2023, renewables already generated more than half of Spain's electricity. By 2024, that share was around 56%. And it is on track to comfortably exceed 60% by the middle of this decade. This isn't just climate policy, it's industrial policy. With that renewable build-out, Spain has increasingly become a net exporter of electricity to neighbors like France and Portugal. At the same time, German industry has been hit by much higher energy costs after the Russia-Ukraine shock. So manufacturers that once defaulted to Germany are now opening facilities in Spain, attracted not only by wages, but by more predictable and often cheaper, cleaner power. For an American analogy, think of a Texas-style energy model, abundant and relatively cheap, but plugged into the heart of a continental market. Third driver, people. Between 2022 and 2025, Spain attracted very large inflows of migrants, including a growing share of medium and highly West-skilled workers from Latin America, Eastern Europe, and increasingly from richer countries. The brain drain story, young Spaniards leaving for London or Berlin, has started to shift towards a brain circulation story, with more talent now arriving and staying. Policy played a role here too. Spain introduced a digital nomad visa with an income requirement set at roughly twice the minimum wage, and later raised it as wages increased, pushing the monthly threshold into the mid-€20,000 range by 2025. Goldman Sachs estimated that this inflow of human capital could be adding a few tenths of a percentage point to Spain's annual growth. It doesn't sound dramatic until you realize that over a decade, that compounding effect is enormous. But there is a fault line running under Spain's success. Recent data show that house prices in Spain have risen strongly since 2022, with double-digit increases nationally and particularly sharp gains in major cities like Madrid, Barcelona, and Valencia. At the same time, average wages have grown more slowly, leaving many households squeezed between rising rents or mortgages and only modest pay gains. In the Canary Islands, this pressure has already sparked large anti-tourism protests, where residents describe an unsustainable model that pushes housing out of reach while visitor numbers hit records. Economists like Angel Talavera point out another risk, a two-way speed in Spain, in which regions such as Madrid, the Mediterranean coast, and the Basque Country grow much faster than interior regions like Extremadura or Castilla-La Mancha. The national GDP number is real, but it hides deep regional divergence. So what can others learn? For the United States, Spain's story shows that targeted industrial